If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Multifamily Monday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What is going on, everyone? Happy Monday. Today, we've got another multifamily topic for you. I'm solo again. I just want to share what I think is an important thing to look out for in the market right now, and that has to do with loan provisions and loan covenants. So for those of you that have bought multifamily using debt, which I'm sure that's probably all of you, right? That's one of the powers of real estate, is being able to use leverage. And the majority of that debt is probably a bridge loan. Especially if you're buying larger commercial properties over the last 2 to 3 years. I would say 85% plus have been bridge loans. And what is a factor of bridge loans, and that is the floating rate aspect of the interest rate, right? So it's going to float. Used to float off LIBOR. Now it floats off of SOFR, meaning as SOFR adjusts, there's going to be a spread depending on the market. A spread between SOFR and the rate they're going to charge. Could be anywhere from 175 basis points to 200 basis points of 2%. Some people buy what is known as a cap on the rate, where they'll pay money to cap it, right? So maybe they'll cap it at 200 basis points, so 2%. So it'll never go above 2% above SOFR, but SOFR is still going to float. So there still is that floating rate aspect. And so there's a few things I want you to look out for, both from a perspective of you currently owning a property and you need to look out for, and also from the perspective of if you're looking to buy properties, there could be opportunities that are going to present themselves due to what I'm about to talk about. And that is certain loan covenants, provisions in the loan. And one is called a rebalancing provision. And what that means is it could be, say, after 18 months, they have the ability to rebalance. And so they obviously lent against collateral on the commercial side of things. That's usually the property itself, right? So that is the collateral. So you bought $20 million property. That is the collateral that they're making. Say they made 75% LTV loan to you. It's based off of that $20 million collateral. Well, a multitude of things have happened over that last 18 months. Specifically in today's market environment. Obviously, rates have gone up. So if you bought with bridge debt, you've floated, right? Because even if you bought a cap, you're still floating because SOFR has been increasing. And say that cap rate runs out, now you're really floating, right? And so that's a problem in of itself. If your cap rate expires, then you're really going to float and adjust, and that may cause you to have to sell because there's going to be a lot of pain. You might not be able to cover that increase. So that's going to provide an opportunity. But the other one I want to talk about is that loan covenant or that loan provision of rebalancing. So after that 18 months, they may have the ability to then rebalance. And so say rates have gone up, cap rates have started to decompress, and the value of that property is not 20 million. Say you've been even able to push your NOI. There could be a chance where the bank doesn't feel. Now, maybe it still is in your eyes worth 20 million and to someone who could buy it, but maybe in the bank's eyes, it is no longer worth that. And yes, they do have the power to make that assumption, that decision. And so what they could do is then rebalance it, but they're still going to need to meet a certain debt coverage ratio, DCR, right? So in order to do that, if the value of the property drops, what they're going to need for you is to put up more collateral, more reserves. So what does that lead to? That leads to a capital call on you, the sponsor. You're going to have to then go raise, say maybe it's an extra $500,000 you're going to have to raise and bring in and put in the reserves. Well, one, your investors are not going to like that. Your deal might not really pencil anymore. And that's going to cause a lot of pain. And I see this is going to happen, whether it's the next 6 months, 12 months, 18, there's going to be a lot of pain, especially the combination of two things of potential rebalancing and rate caps expiring, that's just a snowball effect that's going to lead to a lot of pain. So if you do currently own real estate, commercial, multifamily, I would definitely dig into those loan documents, or at least have your attorney dig into them and see if there is that type of provision where they could do that. And maybe you're in a really good spot where you're not really concerned about that. Hence why it's always important to buy at a good basis. And that's another thing. A lot of people have been paying crazy numbers for deals over the last 2 years, even such as paying a premium for the opportunity, right? And what I mean by that is, so say you're doing a value add deal and you know you can create X amount of value by repositioning the asset. Well, instead of paying for what it's worth today, you're actually paying a little bit over that for a portion of what it's going to be worth in the future for the work you're about to do. So sellers love that, but that's going to also lead to this type of pain because you bought at a certain price that was above the basis you should have been buying at. And this is going to lead to a lot of pain, especially if there's an adjustment in valuation and then they can rebalance that collateral. So I just wanted to get on here and just share that with you because that could create a lot of pain. I don't want to see anyone get hurt. Obviously, it could lead to opportunities where investors like me and others and me and Greenbrier could capitalize on that. But I don't want to see people get hurt. Obviously, I will capitalize on opportunities that present themselves, but I just want to get on here, warn you guys, let you know that this is something that can happen. So check your loan docs and just make smart decisions, guys. Don't let emotion control you. Buy smart, buy at a good basis. And it's also not the worst thing to take your foot off the gas a little bit. You might see people still closing deals and you feel like you're a failure or something. Don't feel that way. Just, you don't know their situation. You don't even know if they're making a smart decision. So just stick with, I know it's hard, but stick within your own mind, stick within your own guidelines, and success will find you. All right, everybody. As always, share this if you found value. That's how we get in front of more ears. So if you have a friend, colleague, family member, anyone that you feel can get value from this, share this. And if you haven't done so, please leave a rating review on Apple Podcasts. Subscribe on Spotify, wherever you listen. That's also how we get in front of more ears. And I just want to help as many people as I can. And as you all know, easy doesn't pay well, and instant gratification is self-destructive. So not only work hard for your money, but have your money work hard for you so we can all create the lives of our dreams and make this world a better place. All right, everybody, I'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.